Welcome. We are going to go over a new Smart Helping financial model. It's for seller financing. You see this a lot in real estate. This is just a standalone calculator. You could duplicate this tab multiple times because all the logic is contained in the tab. But I'll kind of go through and tell you how it works. First of all, seller financing, just to define it, is just um, essentially it's when you sell something and you actually are letting the buyer finance with you. So the buyer is going to pay you principal and interest over time at some interest rate based on some kind of terms that you set. And when this gets really interesting is a business where they do seller financing and their cost, you could think of it as their cost of goods sold, is the cost of the product, and then they make a margin on that. But there's a lot of nuance into how you calculate taxes and all that stuff, which this model does include tax effects. Uh, so um, what we see here is, so this is the only tab in the whole sheet that, um, everything's based on this sheet right here. You've got your original costs. This would be like the cost of whatever it is that you're going to sell. Then you have the sell price. Then you have the down payment, if there's a down payment. And then you have the financed amount, which is going to go through the amortization schedule. The amortization schedule, we have the starting balance, the payment, principal, interest, ending balance, the date. We'll get into this in a second, seller cash flow. Um, and then, so to make this work, we have you can enter a annual percentage interest rate, the amortization. So this is going to define how long the model or the amortization schedule goes for until it runs out. Here we did 25 years, so 25 years times 12 payments a year is 300. Um, but you could define this as any amount. It could be 30 years. In that case, you can see it goes all the way to 360. So, and then you have the first payment date, and then that will define the whole amortization schedule right here. Now, the next part of it is as if you're an investor in, let's say, this property that you bought for 125, you sell it for 375. This is the down payment finance amount. You want to know what your cash flow actually is. And to calculate that, you would actually go original cost. So, like, let's say an investor buys a bunch of things uh, that they're going to do seller financing. They buy it for 125, get down payment of 25, so the net cash flow is 100, and then their cash flow is just the payment per month, total payment. And then on this, what's interesting, you can calculate an internal rate of return on these cash flows by doing the IRR and then converting that monthly rate to an annual rate. Uh, Now, if you do like 6 payments a year, then you're gonna have to change the number of periods in these calculations. Um, well, technically, let's see if we did this at 6. Um, Technically, we could just make this a variable as to this variable because that should be pretty similar. Yeah, okay, that works. So you've got your IRR monthly or whatever period you're putting here, and then your annual. This is the most common situation you'll see is monthly amortization schedules. And then beyond that, I've added a tax calculation, which I had to go look up the IRS rules. And so they do logic to where, based on the gain, which the gain is based on, your original cost basis against your sell price, you have a gain there, and then that is split based on the principal payments. So you have your principal payment here of $234 is different in every period. Well, not all of that's taxable, and so how they do it is they put a percentage that's return of basis and a percentage that's taxable. And the percentage is just based on the total gain divided by the total um, sell price. So you can see here, we're doing $250,000 gain divided by $375,000 sell price. And what that says is, okay, well, of all of this principal that's returned, including the down payment, so this 350,000 plus the 25,000, so this is of that total amount. Here in this case, if 250,000 is a gain, that's 67% is taxed. So every principal repayment, or yeah, repayment you collect, including the down payment, 67% is your tax basis for capital gains tax. And then obviously your other tax is going to be on interest, which is just, that's going to be ordinary income. So that's pretty cool. Got some nice logic in there to do the math. I've also got an annual summary that goes out for, I did up to 31 years, and you can see the totals here. And this just gives you a nice look at the total return, total principal that was return of basis, total principal that's going to be taxable, the down payment that's return of basis versus taxable, and the total taxable gain per year and total interest per year. And then this is the investor cash flow. And so the investor in this case would be whoever is buying this thing that's going to be sold. And there's a lot of nuance to this. Like you could have, um, like this original cost, you might have other debt that you're using to buy this stuff. And then when you get this, when you're selling and you're getting these payments back, your actual return is going to be, because you could have this 125,000 in this case, that 100,000 could be leveraged even more, and then you'll have this, you'll be collecting this, but then you'll be paying out some amount to some senior debt. So you could do that. There's all kinds of different structures that go with this, but I just wanted to try to put the base logic for seller financing, the most common situations you see, and I wanted to include some tax calculations here. So, um, I think that's very actually interesting because a lot of people do this for the tax benefit where you have this deferred amount that you're not taxed on until you actually collect principal, and to know the correct way to do the calculation. Uh, Now remember, you can buy this template in the link in the description box below. Also, I am planning to build a scaled out model of this where you have a company that engages in seller financing as their primary way to sell things. Let's say a used car dealership, or it could be just an investment company that invests in a bunch of properties and then they do seller financing for all the properties, uh, and just have a bunch of leverage situations going on. And you want to show basically this dynamic happening over, let's say, 15 years, and you want to see like your total balances and all the notes and everything else, and you want to see, well, what if I do, what if I have three different categories of products? The average cost is this, the average sell price is Y, and then what happens if I do, 4 or 5 a month in year one, 4 or 5 a month in year two, 10 a month in year three, or however you want to do it. Basically, just scaling this out into um, like an actual financial model that's going to be, and then you could also include some operating expenses in that if applicable. So that's the next step. But this calculator as it stands alone is great. I think this is very useful, and it's very, you can duplicate it. And that's why I put the annual summary on the same tab, so that if you wanted to see, show 5 or 10 of these, you can just duplicate it 5 or 10 times. You can adjust the payment dates here, and note the annual summaries. You can manually, the date here doesn't have to be the first payment date. In other words, you could duplicate this 10 times and then show the have uh, these first payment dates be different times in the future. And then if you still keep this first annual month as 2022 or whatever the month might be, you can get a nice summary of all 5 or 10 things happening over time, and then aggregate the annual summaries if you want. Now, when I do the scaled version, I'm not going to be doing that where you have like hundreds or thousands of different tabs um, to show all the different loans. I'm going to be using some more advanced scaling logic that does, I'm going to try. I don't know actually how, we'll see. I'll be streaming it next week, but I'm going to try to do that, where I have scalable amortization schedules based on loan volumes and counts in a matrix that's going to calculate all this stuff in there. It'll be far more complex because the base logic is complex, but we'll see. I might be able to do it. But again, this logic here is very valuable. It's very complete. I think the tax calculations in here were a great thing to add. So yeah, that's the seller financing financial model. Enjoy, and I'll see you on the next one. Don't forget to like the video, subscribe.